The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me for today's episode is founder, editor John Addis. Hey John, you there?
Yes, I am. Good morning, Gaurav. How are you doing?
Welcome. Now, the audience can't see now, but the remnants of your part-time gigolo job were right behind you. There was you missed out, but there was a whole stack of undies right there for all of us to see, and it was not a pretty sight.
Yeah, I just want to make it clear that if anybody did see them, they are not my undies. They're my son's, and I wish they were somewhere else. I could bring them into view if you want.
We don't really need to do that.
Here they are.
Oh, there they are. All right. Well, you thought you came for the investing insights. You stayed for the underwear.
Stayed for the undies. That's right. At least he washes them.
Yeah, at least. Well, that's good signs there. Nick, you must be just overjoyed that the focus on your filing cabinet is now gone.
I am. That was the first thing that sprung to mind.
Welcome. Thanks for joining us today, Nick.
Yeah, no, good to be here. Thanks, guys.
Now, John, you've been down to a microcap conference, I think. This is one I saw pop up. A couple of interesting companies I wanted to hear from, but since you and Nath were going, I thought I'd just leave for you guys to go and I could just hear how it went from you. So this is a great opportunity. So tell us about this this conference. First of all, I keep hearing from everyone that microcaps are historically cheap, that it's a malign part of the market. I think if everyone is saying the same thing, it's less likely to be true. So I'm not quite sure about that. But I know there was some interesting stocks presented. So why did you go? What did you see?
I went last year. I found it quite interesting, if only to sort of reflect on the absolutely atrocious quality of many of the companies that were featured. I went there yesterday and the quality seemed to have improved. So I think that was a good thing. There were more people there. And I think because the market has been so hit, there are stocks there like MoneyMe where the share price is down, 95%? And the CEOs are out there trying to market what they're doing in a way that they weren't 12 months ago. So there's a definite change in sentiment amongst the CEOs and the small caps themselves. Whether there's a change in investment sentiment, I really don't know. I'd say that's less likely. What were the stocks that you were interested in particular, Gaurav?
Camplify was the top of my list. This is a stock I've owned in the past. It was a bit of a bombed out IPO. I picked it up after the IPO bombed and made some good money on it. But I think what really attracts me is that we know that network businesses, these classified style businesses, these two-sided network effect businesses, I can think of a bit more names for them if I can. These are among the highest quality stocks anywhere in the world. We have wonderful examples of how they grow and how dominant they can be. And here's one in its infancy with a great idea, with incentivized management that seems to be gaining traction, and I'm quite interested in its progress. So I did want to hear your thoughts on it and what the CEO had to say.
I saw 3 presentations yesterday. Nick might be able to add to this, but Camplify was by far and away the best one. Nate's there today. I think the quality of the companies on day 1 was better than day 2, but Nate will let us know that.
Yeah. Okay.
So I saw Camplify, MoneyMe, and EM Vision, which is a medical devices company that kind of does mobile MRIs. Also looks interesting. Camplify was by far and away the most interesting company from an investment perspective. I think it seems to have got a lot better from a year or 2 ago when we did have a look at it and we were talking about it, and I think you actually invested in it. Slowly being established. They're in Australia, Spain, the UK, Netherlands, and Germany. All those markets are growing very, very quickly, and they seem to have an advantage in that their overall product offer to both people who own camper vans and RVs that are listed on the space is really attractive. So they cover off all the insurance and liability aspects in the business, and they're getting lots of traffic. So the people who own camper vans and RVs are encouraged onto the platform, and the people who are traveling are increasingly considering this platform rather than the conventional way of doing it, which is the big rental van fleet-based companies like Brits, who are probably their competition, although one of them owns about 30% of the Camplify stock, I think, as an insurance policy. I think it's really interesting. We're going to write it up, or I'm going to write it up on Friday. Everything seems to be going very well. I think the big risk in this is that, there could be another COVID, I suppose, would be an outside risk that shuts down international travel. There is still competition in this space. They might get bought out too early, I suppose. I would have thought Airbnb, this will be a natural acquisition for them down the track. It's probably not big enough yet, but if it does establish some kind of global supremacy, then I think Airbnb might be interested in it. But they seem to be building a very good, very well thought through opportunity in lots of different markets, and this could be a business that does have global reach and network effects, and they're pretty rare. So I think it's worth us doing some work on it. I don't think we'd issue a formal recommendation on it. It's just too small. But for members who want to do their own research, the story we publish on Friday will probably get them started.
Yeah. Nick, is this one you've come across in your former life in small caps?
Yeah, no, it is, and I agree with the sentiment. It's certainly one of the better small caps out there, and it does look like an acquisition target. I mean, for a company like Airbnb or Booking.com, it's only 130 million market cap, so it's a drop in the bucket for those companies. I think the strategy. I was a bit skeptical at first when they started to expand overseas, but I come around to thinking that was absolutely the right move. It's better to entrench yourself globally than just domestically. I think we saw that with Airbnb, who sort of took over the global market share and focused on the globe rather than one specific country, unlike, I think it was Stays in Australia, that stayed domestically. So Camplify mainly expanding throughout Europe at the moment, and the progress has been pretty good. So yeah, no, it's one definitely on my radar.
One of the things I like about Camplify is that they're a shot at growing the entire market, not simply of grabbing market share from other players. I think this was the secret to Airbnb's early success.
Yes.
And why it was hidden for so long is because the idea just looked ridiculous. No one thought that people would lease out a couch or a room in their house to a stranger. It just seemed like a preposterous idea. And similarly, leasing out your caravan, and people who own caravans are generally very proud of that particular asset. It's an important part of their lifestyles. They've saved a lot of money for it. They maintain it fastidiously. And to have a stranger kind of stay in your caravan seems like an odd proposition. But when you create the right ecosystem to connect in, that can sort of link two parties together, and then you provide insurance on top of that, which would be impossible for an individual leaser to acquire. I think that creates the perfect conditions to grow this market and to actually get to bigger players interested. So it's a stock that's been on my watch list for a long time since I sold it. It's come down a long way, and these are the kind of conditions where not many people are looking at these smaller tech platforms at the moment. They're either obsessed with sort of Pro Medicus and WiseTech and Altium, or they're not looking at tech stocks at all. So these are the kind of conditions that we want to be looking at a business like this, I think.
Just a couple of numbers from the presentation. I think if you go and look at their last investor presentation, they cover some of this, but they take, so from the overall transaction, when somebody rents a camper van for 3 weeks or something, they take 38% of the revenue. That comes out at $437 per transaction. A larger part of that is insurance. It's a fair amount of money. There's lots of repeat business in it, and it's growing very quickly. And as with Airbnb, about 30% of the listings now are small businesses that have small fleets of RVs. So there are people who are buying RVs simply and caravans and stuff simply to put them on Camplify, and that becomes their business. And they're making about 15K per year from renting these on Camplify.
And they actually have good resale value afterwards. So they
That's
buy
right.
these fleets, lease them, earn a rate of return, and then sell the asset.
Sell a vehicle.
To reinvest into a new asset. So it makes a lot of sense for the supplier. And this is the challenge a business like Camplify has. Not only does it have to attract renters, it also has to attract assets. And it has to do that simultaneously. So
he said that's a constraint.
Yeah.
He said that's a constraint. Supply is the restraint. So it's all about showing hirers it's a safe and secure experience for their vehicle.
That's right.
Very interesting company. So that'll be up on Friday.
Yep. No, I like that. That take rate, though, Nick, we've spoken about internally. Just give us...
I knew this would become a podcast on Camplify.
Sorry, I didn't mean it to. But it's just so interesting. Nick, give us a broader a look at how that take rate fits internationally, because that's high. You said more than 30%, John, is high.
It is high. And so Airbnb and Booking take about 13%.
Oh, wow.
So, so it's about double that. It's incredibly high, and I guess that may be a risk, but it is a niche market.
Yep.
Like you're talking about a $2 trillion accommodation market, so there's lots of competitors there. Whereas this is, I don't even know the total addressable market, but it's a lot smaller. And there just isn't the competition that even the Airbnb or Booking or Expedia have in those markets. So for now, they're getting away with charging those take rates. But if they come under pressure, if they were to come under pressure, it would be probably due to competition that isn't there at the moment.
Yeah.
I think those take rates also include a insurance margin as well. So they don't underwrite their insurance policies. They have an agreement with Allianz, and Allianz takes care of all their insurance, but they do broker their own insurance. So they do take I think it's like a 30% margin on the insurance, which I think that gets captured into the take rate. I'm not sure how they account for that, but that'll be something that might explain why the number is higher than we would expect, because that does sound very high. But they are creating their own market. So you're right, Nick, at the moment, not much competition for them. To hear them say it, they don't think there's anyone of their scale globally. So they are the market leader already. And that's really important in this kind of industry where the profits tend to go towards the top one or two providers in the entire industry. So you really need to establish dominance if you're going to be profitable.
A couple of other stats, SaaS-based metrics, customer acquisition cost, very important metric for this business, I'd imagine. This is the cost of getting a hirer. So once you get a hirer, you can expect to make $437 per transaction. They are spending $11.68 to acquire a hirer that will generate $437 per transaction.
That's very good. That's among the highest I've heard.
That's astonishingly
LTV to CAC,
low.
It's very good.
It's astonishingly low. It's almost Tesla-like. Like they don't do a lot of advertising. People are just finding them, coming to them. Very different from Airtasker, which was another presentation that was done. Like the CEO was excellent, but I think he's just in a way worse business than Camplify.
Oh, no doubt. Airtasker is a introduction service where they link the two parties once, and then after that, they're basically not involved in any future transactions. Whereas this, because of the insurance aspect of it, once you link parties together, you're always forced to really use the platform all the time.
I'd be surprised if they weren't thinking about insurance for those little jobs. It might only be $2 or $3, but that might be some kind of lock-in they could try and get. But
Airtasker,
but it's going to be nothing like Camplify's.
Right.
And the owner's CAC. So if you have a camper van and you decide to rent it out on Camplify, it costs Camplify $135 to acquire a new owner. So if you look at the overall CAC, so you need the owner and the hirer. Once you've got the owner, like that's for multiple hires. So there's a much longer lifetime value on that. and then you've got the CAC on the hirer themselves, and that's only $11.68. Those metrics are phenomenal. You know, I know SaaS businesses, I've worked in them, consulted to them, sat on the boards of SaaS businesses, and they're kind of astonishing figures.
Yeah,
All right.
absolutely.
I like it.
I think the other thing, just to point out quickly, not only the insurance side, which reduces friction, but I think in Australia they have roadside assist is covered. And I know if I'm a renter and taking away someone's asset, I'll be really worried if I break down or if something goes wrong. So they've done really well there. I think they've got a partnership with NRMA to provide that.
Yeah,
that's a good point, Nick, because these things venture almost by definition into really unusual territories. So I think that's an important part of the service.
Yeah. Well, I mean, we're getting into way too much detail here, but it is fascinating. They're expanding across Europe. They've got a deal where they can sell insurance across Europe, and they take a 30% commission on that. They've heard that Italy, everybody talks about Italy saying being a terrible place to rent camper vans. For what reasons I don't understand, but they've got an across Europe approach now, so they can enter those kind of markets and do it in a way that they've been doing it in Australia and New Zealand. They've also got a temporary accommodation program. So when I was living on the north coast of New South Wales and there were floods there probably about almost 2 years ago now, I think that the rescue village for people who've been made homeless was completed probably 6 months ago. So it took me well over a year to make this village to house people. Camplify have this temporary accommodation program where the government hires camper vans and caravans en masse to move into an area that's been affected by a government disaster, and the government pays the cost. And Camplify sort of batch it all up and do the insurance and take a cut. So there's lots of interesting little things happening in this business, but in terms of the big metrics and the important metrics, it's very interesting. But there are going to be more acquisitions, I'd imagine. Lots more acquisitions.
You know, just on that last point there, John, John's Ling Group has, which is a kind of it's actually a builder constructor to the insurance industry. They've managed to weave this narrative that they're exposed to climate change. And so they get these multiples that just really difficult to justify. And I wonder if Camplify might eventually weave that same narrative, attract those same multiples. This is not something we would advocate, but looking for those stories that can turn into meme stocks, it's not an unprofitable venture.
Meme stocks.
Let's just say.
We're going to be out there.
John Ling is not far away from being a meme stock. I do not understand the multiple in that business. To me, that's a low margin kind of construction business, and it's a wonderfully run business. I think it's a high quality business, but the multiple it attracts, I think, is completely detached from reality. And that's
used
thanks
to be
to the
a
story.
business that every value investor in Australia used to own. John's Ling. And now it seems as though every investor in Australia owns John's Ling.
Yes, that's right. Yeah. Well, once the share price starts rising a lot, that's amazing. That's amazing how a rising share price can create its own narrative, and a falling share price creates its own narrative. Most people who analyze stocks, and I hate that, at the risk of sounding down on my fellow investors, most people analyze stocks, especially those who do it for a living. All they do is follow their share price and come up with reasons to tell you why a share price has done what it has done. And there's just very little.
You're so cynical.
More than usual today.
More than usual. Yeah, you're probably right. Actually, you know what? That is the perfect place. Let's take a little break, and we'll come back. And Nick, I want to hear from you next. There's an interesting thing to ask you.
If you like the sound of our investing approach but you're not yet a member, visit intelligentinvestor.com.au and take a free 15-day test drive of our membership. You'll get immediate access to all our current buy recommendations, model portfolios, and engaging educational research, tailor-made for people who want to manage their own money. That's intelligentinvestor.com.au for a free 15-day trial. No credit card required.
Nick, on the international side, one of the stocks I have been most curious about is Rightmove, because this is essentially the REA of the UK at half the multiple. But we got some bad news the other day. I want to get your take on it. What does that mean for the Rightmove itself? But more interestingly, can you tease out any implications for REA? REA is probably at the top of my list in terms of businesses I want to own, and I've never owned it, and it frustrates me no end. Is there going to be a shot at buying REA at some point?
Well, I'll tackle what's happened at Rightmove first.
Yep.
The third competitor over there on the market, which has about 7% market share compared to Rightmove that has 85% market share, has been acquired by CoStar. And CoStar is a $30 billion US company that has a history of turning around underperforming property portals. So in 2014, they bought apartments.com, which was the sixth largest rental portal in the United States. And that's now the number one portal. They're doing this, in residential as well to take on Zillow. They bought homes.com 2 years ago, and it only had, I think, traffic of around 7 million people per month. And now that's up over 100 million within just 2 years. And then now they've gone from the sixth biggest player there to the second in terms of traffic. And they're looking to monetize those eyeballs next year. So I think that's why. So the Rightmove share price has fallen 15% as CoStar has acquired on the market, because the market's worried that they'll come and try and do the same thing to Rightmove. So they've announced over £100 million investment into sales and marketing. In the first year, that's going to be £46 million, which is 3 times the annual budget of Rightmove. So even if Rightmove can defend their position, it might actually mean that margins come down as they have to spend more. In terms of implications for REA, CoStar have announced that they're moving more into Europe. So the German property portal, or the REA of Germany, Scout24, has the share price has also fallen. They haven't announced any plans for Asia Pacific, I don't think, yet. And we don't have any tiny competitors. We just have the two, really. It's this duopoly between Domain and REA. And Domain would take a far more substantial investment, I think, to take on REA than what they're planning to do in Europe. So for the moment, I don't think there's a risk to REA. But it is interesting that what I would have said only a week and a half ago is a completely entrenched position that another company in the US with form in doing it has seen that as a real opportunity and a target.
I'm amazed by that as well. I would not have guessed that would have been possible. It's interesting to look at the market structure here in Australia with REA and Domain. REA would have to be just one of the most dominant businesses on the ASX, and Domain has never really caught up. There should be room, I would have thought, for two profitable, high-returning businesses in this segment. Such a big market. But Domain has never really posed a threat to REA. Maybe in Sydney, I don't know the market shares that well, Nick, but maybe in Sydney, but certainly globally, certainly nationally, REA trounces the competition. Mm-hmm. Is that, if things change in the UK, I mean, is that indicative of what could one day happen here, or is it different in Australia?
I mean, it's hard to say. So to start with the UK, I actually think there's we've still got a buy recommendation on Rightmove. I think CoStar will ultimately fail in this endeavour.
Why do you think
there's a few reasons. Rightmove have... so Google's taken on Rightmove, Zoopla on the market itself, Purple Bricks, and they've thrown advertising dollars behind it. Maybe not the same investment as CoStar, but it's always failed. This is CoStar's first foray overseas as well. The UK market is very different than the US market. The US market was still very fragmented, where there was like 8 or 9 competitors. In the UK, it's really just Rightmove. Rightmove and Zoopla have 93%, and on the market have the rest. There's hardly any competition. It's not the same market dynamic. The other thing is they're just trying to target. They've already got this. So on the market, we'll bring the sellers, the agents, on board. So that's why they're making this acquisition rather than doing bootstrapping from the ground up. But the other side, the buyers, they're very entrenched. So why would if I see a few more ads, am I really going to rush over to On the Market or their new version of homes.com? If I've been using Rightmove and happy with Rightmove for the last 20 years, I think it's sort of like Google search and Bing trying to take on Google search. I think there's just people underestimate how ingrained that thought process that you just go there, without any thinking is. So I think it'll be actually pretty hard for them to take them on. And also, Rightmove's in a good financial position where they can actually defend their market position. Now, that might mean lower earnings, but I think they'll be able to defend traffic and listings.
See, what I don't understand is the thing about Camplify is it, and Airbnb and REA is that you have a two-sided market. And that's quite hard to shift because you have to bring the users over and you have to bring over the suppliers.
Yeah.
And that's why these companies have failed. Presumably they're not stupid.
No.
What is it? What is it that's convinced them that they think they can win this?
Success in the US. So they've done this in the US. So On the Market have about 13,000 agents, and Rightmove have about 19,000 agents, which is practically the entire market. So they're buying the agent side and trying to use marketing dollars to win over the other side, the buyers, the eyeballs. And they have done this with large investments in the United States. So they think they can now move into another country and do it. I'm not as convinced.
There are some unique characteristics. Just coming back to REA, stock I'm obsessed about, really. There's some unique characteristics about the Australian market. I think that prevents something similar happening here. One is that the seller pays for the advertising on REA and Domain. So the more properties you introduce, the more cost you incur as a seller, the less likely you are to actually pay for a competitor. And the costs are high. I think sort of years ago, 7 years ago, we're talking now, when I sold my property, I think we paid about $3-4 grand for each, for a listing on REA and Domain. And remember at the time, the agent said, you should pay for the local paper, the local courier as well. And so I checked out how much that was. It was $6,000 for a little ad in the physical local courier. Yeah. And I just laughed out. I remember laughing in his face.
Yeah, you're just advertising their business for them.
Yeah, exactly. And it just also, so that's one thing. That also, by the way, highlights just how shout out to any real estate agents listening, but I just think that's the most useless job in the country. You basically list on the,
I knew
the seller.
How to win friends and influence people.
Well, think about this, right? The seller pays thousands of dollars to list a property on the portal that gets people to come and see your house. The real estate agent opens the door and then takes 2% of the fee. There's a reason why it takes a weekend to become a real estate agent. But we'll leave that at that. The other thing that entrenches the local too is just the tie-ins with media property as well. So Domain is tied in with Nine and Fairfax. And REA is tied in with News Corp, and that integration, I think I've underestimated the strength of that in the past, but it does seem to provide benefits. And another player coming here just doesn't have those linkages, those advantages, and likewise, overseas properties don't benefit from those linkages either. So you may breach an overseas portal, but you might not breach the local one.
Yeah.
No, I agree.
Does anyone own REA that they can boast about how well they've done? Because I certainly don't. I don't think we don't own it in the funds. It's stock that everyone acknowledges is maybe the best business in Australia, and I find it amazing that none of the analysts own it, and we haven't owned it in the funds. And it's just
hard for us to buy a business that always looks so expensive. I think that's one of the mistakes that we made. Over the years we haven't been prepared to pay up for quality to the extent that we should. And REA was a great business right from the very start. very early on in our history, and we missed it. I think we missed it.
Yep. No, you're right.
I think what people always underestimate is just, even though REA and Domain or REM also have been entrenched for well over a decade or even longer, just how much the market grows, and then the percentage they can take within that. No one thought 15 years ago that you're going to be paying a couple of $1,000s to REA for a property ad, and they're only going to be still taking, I think.
Well, Gaurav definitely
10%.
didn't. He doesn't even think he should now.
Yeah.
Well, I think at the end, there's just so much growth ahead, because if you look at the transaction of property, like, it's a massive transaction, and the fee you pay for the most value in selling that transaction, you actually pay the most fee to the agent, whereas the most value is created by the portal. And I think that mix between what you pay and what you get is going to change. It has been changing over time. Like, the REA's take of the transaction value has been rising, but it's still way below what the agent takes. And I think that switch is just going to continue. So it's baked in growth for years and years and years. There's so much pricing power on that REA platform. They've only really scratched the surface.
I want to say it's about 10 to 15%, and Rightmove is about 6%. The actual take rate of all the transaction fees when you sell a property. So, you're right. There's still so much there to go.
Yeah. Well, I just remember the bill I paid my agent who opened the door, and the bill I paid for the portal, which sold the property. It was multiples. I mean, 10 times. It was an order of magnitude of difference. And I just can't imagine that will persist over time. And I have heard REA management, they don't say this anymore because a lot of their customers are actually real estate agents, but I have heard them say that it's an open strategy for them to actually take more of that transaction value at the expense of agents.
I think every July 1st they increase the price. Every year, like clockwork. I think this year it was like 13%. Other years it's 8 to 10%.
Yep. And for everyone, all those real estate agents listening, you can send your complaints to intelligentinvestor.com. Let's take a little break here.
Sodi at.
Yeah, that's it. I'll keep an eye for them. Let's take a little break here, and we'll finish on another hot take.
If you enjoy our approach to investing but you don't want to manage your own money, check out Intelligent Investor's range of managed funds, including income, growth, ethical, and international options. Decades of research and experience are distilled into these 4 managed funds, with a focus on achieving outsized investment returns. Check out our performance track record, fees, and approach at intelligentinvestor.com.au/funds-overview. That's a mouthful, so once again, that's intelligentinvestor.com.au/funds-overview.
Gents, to wrap up, I thought I would finish with a warning sign. I keep seeing a lot of buy recommendations on TPG. I think they still call it TPG Telecom, right? Yeah, on TPG. And it's a business we recently ceased coverage on. I was scathing of announced plans to sell fiber assets from that company. But when I took a closer look, I can see what's happening here. TPG is failing. And I think there's a chance that this company disappears or stops providing service to everyone, because this thing is not working. It is badly run. It is poorly capitalized, and it is, in terms of operating success, well, it doesn't have very much. And that's a lot of that is hidden because the numbers are still looking reasonably good. But let's run through quickly what's happening here. So TPG is roughly a $6 billion market cap. These guys have more than $3 billion, $3.5, maybe even $4 billion of net debt. That's an entirely too much debt for a business like this. They're still paying out dividends when they probably shouldn't be. And the PEs and the numbers all look pretty good because they're paying no tax, because they've got a big load of losses from Vodafone that they're crunching through. So the net margins are elevated. The debt is too high. They have a huge CapEx expense. And it looks to me they're not really spending as much on CapEx as Telstra is. So competitively disadvantaged that way. They're sitting on a big load of fiber, which is actually the best part of TPG, is the internal fiber business. 65% margins, locked in revenue, incredibly scalable. Might even get to 70 or 80% margin at full scale. But they want to sell all that fiber to repair the balance sheet, because that is just crippling the business. And then you turn to the operations, losing market share on every metric. The Vodafone network is just uneconomic. They're just not making money on the Vodafone network because not enough people use it. This is a big, expensive fixed cost. The only way to make money is to get lots and lots of users on, and they're just not getting the users. And I don't think the Vodafone network is viable. I think it might make sense to close that entire network down or to sell it, and it doesn't look like it's ever going to make money to me. I think this is a failed business. I think it might even be like technically done. I'm so negative on TPG. If you own this thing, this is a hard sell for me. I'd be getting out as fast as I could. All right, hot take, guys. What do you reckon? Nick, you going to sell your stock?
I don't own any, thankfully. I guess sort of maybe the writing was on the wall 2 years ago when the founder, David Teo, just stepped away from the business altogether to go and pursue other ventures. And I think he put a sell recommendation on it at the time. And looking back on it, I know this is with hindsight, but when a founder owner steps away from the business, I think it is better to just, you step away as well, you just sell your stock. Yeah, just bail with them. And it's hard to do because usually the stock's off, 20% or so.
Yeah.
But I think it's the best choice. And this is just another lesson again. And for me, the other thing, it reminds me a little bit of Star to a degree, where you've got this actually really good asset, in this case the fiber asset, but a bad balance sheet. And now they're getting rid of that great asset. And Star had this great asset and still does, but has diluted it away because it's had to use capital raisings rather than an asset sale to repair it. And even really good businesses, when they have bad balance sheets, can become quite poor ones pretty quickly.
Balance sheets. I mean, we all know this. We all know the importance of balance sheets, but it's really hit home for me watching the casinos, in particular, just how important it is to just not get involved with debt-impaired businesses. Just companies that are carrying too much debt. It's so much risk. You only need a small number of things to go wrong, and the whole thing doesn't just go bad, it implodes. I mean, Star is a great lesson, really, and it's one, unfortunately, we learned the hard way.
I think
sorry, go on, Nick.
Yeah, I think this with the balance sheet risk, I think everyone knows the risks are there, but I think they have been forgotten because we've had interest rates at zero for over a decade. And now that's changing, and these things, companies with debt are starting to, blow up, I guess.
Yep.
Gaurav, what's your view on the ACCC? Because they blocked that agreement between Telstra and TPG to get rural access, didn't they? Do you think the ACCC, if this does fail, the ACCC going to have a hand in its failure or not?
Yeah, I do not understand that decision. I really don't. I've done some work with the ACCC in the previous life, and I found it to be an incredibly intelligent, thoughtful organization. This was sort of going back 20 years, but I just don't understand these recent rulings. We can line them up one after the other. I don't understand it, and this is a prime example. I don't get the objection. All they were trying to do was to create a legitimate competitor, Telstra, which is the monopoly, and in doing that, they've sort of named TPG anti-competitive, which just it's almost humorous, how ridiculous that is. But this is what happens when you have a checklist and all you're doing is ticking off a bunch of rules unthinkingly. You end up being counterproductive and doing the opposite of what you're trying to achieve.
I think you can see that in the US as well with Alina Khan, where the Department of Justice there are clearly going after big tech, but they're just going about it in a way that really doesn't make a lot of logical sense and are going to undermine the case for antitrust measures in presenting cases and going before courts and arguing for stuff that really, from a user perspective, doesn't make a lot of sense. I think they're going to lose a lot of political legitimacy in the way they're going about it, and the companies and the cases they're choosing to prosecute. This seems like a local example of that. It just doesn't make a lot of sense.
I just want to cycle back on one thing that Nick said. Nick, you mentioned about the what to do when the founder leaves. I was just thinking, as you said it, that Lovisa is actually, that's my biggest holding at the moment. When the founder of Lovisa left that business, the stock price fell a little bit, but I wasn't at all, it never even crossed my mind to sell stock or to exit the stock, because the relationship of the founder to that business was secondary when compared to the relationship between Brett Blundy and that business. So if Blundy tomorrow, out of the blue, sold his stock and resigned from the board, I would sell my stock very, very quickly. Yeah. And so there is some nuance in these decisions. And Tio, not only was he the founder of TPG, he was the industry doyen. He was the mastermind behind this whole thing. And the departure came with no warning. It was sudden and it was absolutely complete. He had sold out his stock very soon afterwards, and his son left as well. And I think it's a very different scenario.
Yeah, absolutely. It's the same with Jeff Bezos stepping away a little bit at Amazon. Yep. You're not worried. He's still got his stake there. I think he's still the executive chairman. And it was, sort of something you could sort of foresee happening. Bill Gates at Microsoft, for example, is another one. But yeah, this case was very different.
All right. Let's wrap it up there, guys. Great conversation. John, thanks so much for taking one for the team, going to the conference and taking notes on...
One for the team. It wasn't that hard.
I think sitting through a bunch of crappy microcaps. Yeah,
no,
you took one for
true.
The team.
Yeah. Well, Nathan's doing that today, so it'll probably need to be picked up tomorrow.
There's a reason why Nathan earns the big bucks, stuff like this. Thanks for your time, John.
Thank you.
Nick, maybe it's my turn to have a weird piece of undergarments in my background next time. John did it. You've done the.
That's right.
Your bit. I need to do something as well.
I'll set a trend here.
Yeah, an odd joke on the whiteboard. That'd be great.
I was thinking about that. We should start writing something on that whiteboard. That whiteboard is used in my day-to-day life. That thing is used a lot, but I can always, I think it's a good idea. It'll come out backwards if I write something. I have to write it in reverse, do I? I don't even know how that works. We'll try it out.
I don't think so.
No, I don't think so.
Yeah, but now I know nothing about recording after all these years.
It's not a mirror.
It's not a mirror. There you go. All right, this is the perfect time to sign off. Thanks very much for joining me, gents, and for everyone else, thank you for listening.